How do fixed exchange rates use par value? Imagine a world where currencies are like steady ships sailing on calm waters, never drifting to or from their set course. That's what fixed exchange rates aim to do. They keep the value of one currency tied to another, creating stability in international trade. But how do they decide where to anchor that ship? That's where the idea of par value comes into play. Par value is like the official price tag of a currency in relation to another currency or a commodity like gold. Think of it as the benchmark or reference point for the currency's worth. Historically, currencies were pegged to gold, meaning their par value was based on how much gold they could be exchanged for. Even though the gold standard is mostly gone now, the idea of a par value still influences how countries set their exchange rates. In a fixed exchange rate system, the government or central bank uses the par value as a starting point. They decide on a rate that their currency should be worth compared to another currency. For example, if a country wants its currency to be worth $1 and the par value is set at that rate, the central bank will try to keep the currency close to that value. To do this, the central bank will buy or sell its own currency in the foreign exchange market. If the currency starts to fall below the par value, the bank will buy its own currency to push the price back up. If it rises too high, they will sell their currency to bring it down. This constant buying and selling help keep the currency's value stable around the fixed rate. Sometimes, the par value acts as a guide rather than an exact target. Countries might adjust their fixed rate if economic conditions change. For example, if inflation rises or trade balances shift, the government might decide to change the peg slightly. But the main idea is that the par value provides a reference point that helps keep the currency's value predictable. In modern times, fixed exchange rates are more often set based on economic policies and market conditions rather than strictly on a par value. Still, the concept remains important historically and as a reference point for understanding how countries manage their currencies. It's like having a clear, steady anchor in a sometimes unpredictable sea of international economics. So, in essence, fixed exchange rates use par value as a benchmark to determine and maintain the currency's official rate. The central bank then actively intervenes to keep the currency close to that reference point, ensuring stability and predictability in international trade and finance.